Good afternoon, everyone, and welcome to the Monday Open, hosted by Vantage's private client team. My name's Jeff. I'm in Sydney, usually joined by Mark in Melbourne, but Mark is still on paternity leave, welcoming his new baby. So again, you're just going to have me for today. This is our regular Monday wrap-up of last week, this week, as you'll see from the agenda. Nothing new or inspiring. We're going to go through what were the big market moving events of last week. What are the big market moving events that we're seeing for this week? We'll do a little bit of technical analysis and we'll answer some questions at the end. So the big stories of last week, on Wednesday, we had a US CPI that was softer than expected. On Thursday, their producer prices were softer than expected as well. For those who are a little bit new to the game, the difference between PPI and CPI is that PPI is the producer prices. So it's a B2B measure of inflation and inflationary pressures, whereas CPI is the consumer price inflation. So you would think of that as the CPI is the difference in costs of you and I going to buy things, whereas PPI would be if Ford or Holden had to pay more on their iron ore prices to make their cars. So it's just further down the value chain. All of those price increases obviously filter into the end. And what we normally do is we see that the PPI is a leading indicator for where the PPI will be in 2 to 3 months forward. So softening consumer and producer prices in the States is a good thing for inflation. We also on Thursday had the Bank of Canada cut their interest rates by 25 basis points, which was absolutely as expected. I don't think a single economist anywhere in the world was expecting them not to. It looks like Canada might actually take a bit of a break on their recent easing cycle, just for the time being, just to see where the market does normalize itself. Obviously, Canada is also dealing with some tariffs out of the US. And a weaker oil price. The Canadian dollar, or the loonie as we like to call it, is very, very influenced by the oil price because Canada is such a major exporter of oil. Over the weekend, we had a domestic stimulus announcement from China. This is the 6th or 7th domestic stimulus announcement from China in the last 6 months, and I guess the market's getting a little bit jaded about it. This one is going to focus on childcare subsidies and specifically increasing people's money in their pockets at home in China. So we're not. They didn't release anything on tariffs or on protectionism there. It was just about trying to have a little bit more of a modernized economy there, where childcare is paid for by the government. I don't know the full result, whether it's going to be fully paid for or partially paid for, but I think they're also talking about maybe potentially reducing some taxes. So that was last week. Also didn't make the chart, but last week gold did finally hit that $3,000 level, touched it, broke a little bit above it, came back as you would expect from a round number. We're going to be talking about gold in the technical analysis component of it, and we're going to be doing that a little bit differently as I like to do. The other thing that the market is kind of fearing at the moment is the recession in the US. That's why you saw some pretty big falls on the US equities over last week. Currency markets were pretty quiet, and equity markets were the ones that were actually moving around. The S&P 500 actually hit a technical correction level, which means it's fallen 10% from its previous high. Obviously, that was the cover of the Wall Street Journal, and that then starts to become a self-fulfilling prophecy. People see recession, people start to worry. That was last week. So this week, we've got interest rate decisions out of Japan and the US on Wednesday, both on Wednesday. The market is expecting unchanged for both of those. I think the risk is on the Japanese maybe increasing rates rather than the US doing anything. I think the chances of the US doing anything at all are less than 10%. I think they need to start working out what they're going to do with tariffs rather than just putting them on, taking them off, changing them and adjusting them before they actually decide anything with the interest rates. Excuse me. I think Colin Powell, the Fed president, would probably rather see that tariff debate calm down a little bit before he starts meddling with interest rates a little bit. On the other hand, we've seen some comments from BOJ and MOF officials in Japan over the last couple of weeks worrying about interest rates, about inflation, and about currencies. Just to explain that dichotomy there, the Bank of Japan, or the BOJ, is the Bank of Japan, and they are the ones who implement in the market. So they are like our RBA. They would be the ones who would do currency intervention. They're also the ones who set interest rates. The MOF is the Ministry of Finance, which is a government elected set of officials. They influence the BOJ more than any other central bank is influenced in the world. So the BOJ generally works off instruction from the MOF. So the MOF comments in the markets when you're watching your Reuters screens are probably more important than BOJ official. MOF are the ones to watch. On Thursday here in Australia, we've got unemployment. I think it's going to be a little bit better than expected. The market's expecting 31.4 thousand new jobs. I think we might be pushing into the 40s. Just a feeling that I have. No particular analysis. I just think that the market is a little bit underdone. And it seems like some of the people who are expecting that number have priced in a lot of the casuals from the Christmas period to have been taken out of the Aussie market. I don't think that will actually be the case. Employment here is pretty tight, and I think that we're actually going to get a number with a 4 at the front of it rather than a 3. So they were the big issues from last week and what we're looking for this week. When nothing really until Wednesday. I think markets will be pretty quiet until Wednesday, barring any more tariff talk out of Trump or reciprocal tariffs from anywhere else. On the technicals, I thought we'd do something a little bit different today. Obviously, gold was, I think, the best or the second best performing asset class last year. As you can see from the weekly chart, it pretty much just went straight up. Excuse me. It kind of broadened the question of, or broached the question of, if a market is just going one way, how do we enter? And obviously, I had a little bit of a think about it. One of the rules on my system is that when a market breaks to a new high or a new low, you go with it. So if it breaks to a new high, we're looking to buy. I know that a lot of people out there try and fade the turning points and try and pick the points. If you look at gold, if you sold gold into rallies last year, you pretty much would have lost your money very quickly. That break above 2,000, so the sort of 2,080 level was really quite important. We've seen it now since then, or the chart will show it goes up to 3,000, so it's up 50% from that parallel line. Hopefully you guys got onto that a little bit last year, at least, taking some chunks out of it. But I mean, in terms of how do you get into that, you can see that over the course of the entire year, there are only 2 minor pullbacks to buy. I think maybe with these sort of explosive markets, trading is difficult. And there's also the trading psychology around missing out on the move. So we'll try and educate around how to trade these big impulsive markets. Also, just to keep in mind, for people that have spoken to me on the phone, you'll know that I quite like commodity markets and softs more than the hards. So the softs are things like cotton, corn, and soybeans and coffee. Those markets tend to move like this quite often. If you get a spare couple of minutes, have a look at coffee and cocoa over the last 12 months. They've had massive moves as well. These moves tend to be quite big, quite unidirectional, and don't really allow much of a pullback in terms of buying that dip. So how do we do it? So breaking down from the weekly to the daily chart here, you can see, it was pretty much just one-way direction on gold last year. Like I said, one of the things with my trading system is that when something breaks to a new high, I like to buy it. When something breaks to a new low, I like to sell it. What you want to do, and I mean, these round numbers especially are very important, that 3,000 level. These round numbers are important because markets will tend to touch the level, break slightly above the level, then come back slightly and then continue up. It's around the psychology of the way that players place orders. When something hits a new historical high, there generally isn't any offers above it. If people are long and a market goes up, they're not really looking to sell it. They're looking to add to the long. So when a market touches those sort of round number important key levels, you won't really see a lot of selling come in. That's why it's important to trade these impulsive markets in a different way than you may normally trade them. Generally speaking, and I mean, the guys on the floor here will tell you that I'm always screaming that whenever something hits a new high, you buy it. Whenever something hits a new low, you sell it. So for these markets, what we want to do is we want to trade the very small consolidation back up right after the new high or new low. So what will happen is, and it always happens in Asia, right? So the market will hit its new high or new low in New York or London, and then we come into Asia, and Asia kind of just sits there. That's when you want to get into the move. Asia is a good time to do that because there's decent liquidity, but it's not very directional, especially on something like gold, which is only really traded out of Hong Kong in Southeast Asia. We want to keep really wide stops on these moves just because, the trend remains. You don't want to get stopped out of a long-term trade just because you place your stops too tight. Next week, I might do the technical just about stops because I think that a lot of people really do place them incorrectly, and especially moving them. Don't move them. And I mean, point three for me, and this is the most important one, don't fade the trend. If the market's going up, don't sell it. I mean, it really is as simple as that. I had a client years ago say to me that she sells it when it gets to the top of the chart and buys it when it gets to the bottom of the chart. And I'm like, well, you know what? Charts adjust themselves. Markets can go haywire. We had, I think, 26 or 27% up on gold last year. It was about the same the year before. So really, it's up about 50% in the last 2 years. Doesn't look like it's going to change anytime soon. And then you look at it from the fundamental perspective, there's no real reason not to have buying of safe haven assets at the moment. We've got a bit of a loose cannon as the US president. We've got wars in Ukraine and the US and Russia. We've got wars in the Middle East. That war's pretty much been going on since Jesus was a boy. There's no reason to technically or fundamentally to be fading these gains on gold. I would be maintaining. Let me just pull that chart back a bit. That long-term trend is where I'd want to keep my stop on a really long-term position. But this low up here, the most recent low, I think is a safe spot for gold. I don't like to project up in terms of where a market can go. I like to just ride the move. But we were talking in the office kind of middle of last week, and I think, it's just hit 3,000. There's no reason for it not to get to 4. I don't think it's going to get there anytime soon, but I mean, between the next 12 and 18 months, I don't see any reason why gold can't have a 4 handle. So that's for technicals. If you've got any questions about that sort of stuff, don't be shy to pick up the phone and reach out to either myself or Mark when he's back. We're happy to talk you through around, kind of market accepted ways to trade these sorts of markets. Obviously, there are different markets and you need to trade them in different ways, and markets do change from time to time. So just to finish up, this is a section where we normally get questions from some of the guys that we're talking to on the phone, and we like to broach those questions with a wider audience because they're maybe a little bit more interesting than the normal questions that we get. Question 1: where to from gold? Where to from here for gold from here? I don't see any reason for it to go any lower. By any lower, I mean, it could fall $200 and still be very, very bullish. Honestly, I just think gold's going to go up. I don't see any reason not to. Central banks is going to start coming in and buying at around this time of the year as well. They've been pretty quiet for the first quarter so far. But I mean, we had very good buying of Indian and Chinese central banks last year. There's no reason to think that they've finished. They're not going to be buying crypto the way the US is. Excuse me. So I think higher for gold. This one came actually from our marketing department. How will the Australian election impact the Aussie dollar? Obviously, we don't want to get too political here on a point of favour or against a particular political party. Generally speaking, across the entire world, so this isn't even really just about Australia, but across the world, conservative parties are generally better for the economy. They're less spendy and more about trying to fix budget deficits and keep interest rates and employment low, whereas your lefty type political parties are generally a little bit more about spending, a little bit more about immigration and appeasing and keeping people happy. I think the election as it stands right now in Australia is that Anthony Albanese is still the preferred Prime Minister, but the Liberal Party is the preferred party. Albanese's Labor Party is still a first-term government, and I don't think a first-term government has been thrown out on their election, their first election back since the mid-70s. So I don't know. This one's still pretty evenly balanced, but we'll see how it goes as it gets closer. There was also a bit of a rumor going around the markets today that the election date will be called after the budget. The federal budget is due Tuesday of the week after the next. So sometime after that, we should get an answer. So that's it for us today. Obviously, this video is being live streamed to our VIP chat room and to our YouTube channel. They'll be there. It'll be on both of those after we're finished. The VIP trading room, if you haven't visited, is a really cool place for you guys to visit and interact. We've got some analysts out of the Everest Fortune Group. They can interact with you as well. They can provide a bit of analysis and answer questions. I'm logged into there all day long as well. So if you want to shoot me a note or share a chart, feel free to do that through there. We also have our technical weekly video every Monday that's uploaded to our VIP trading room. And we have our private client daily update, which is a wrap-up of overnight trading that my team and this week me sends out every morning. If you want to be added to that list, please just reach out and feel free to be added. Just shoot me a note through the trading room, pick up the phone, or send me an email. That's it for today. Thank you very much for your time and good trading.